I want you to look at your portfolio. Okay, look at your mortgage rate. Look at the price of gas. Now imagine a single loose thread in a sweater, halfway across the world. You pull it just a little bit, and suddenly the entire thing just unravels.
And that's not a metaphor anymore.
That is exactly what is happening in the global economy right now. We are not talking about a theory. The trigger has officially been pulled.
It has, and honestly, unraveling might be too gentle a word. We are looking at a structural break.
We are talking about Japan. And before you tune out because you think this is just foreign policy, don't.
Please don't.
The breaking news out of Tokyo is the single most important financial story for you, an American listener, today. The election results are in, and they are, well, catastrophic for the status quo.
This is the end of an era. I mean, the era of cheap money, all that liquidity that has propped up U.S. stocks and real estate for a decade is officially dead.
So here is the mission for this deep dive. We're going to explain why a landslide election victory in Japan is about to trigger what you could call a global margin call.
Right.
One that could crash the U.S. Treasury market. We are going to connect the dots between a ballot box in Tokyo and your 401k.
And we should probably start with the bottom line. The result of this election is that Japan is now locked into a spiral. Massive spending, massive debt.
So to survive.
To survive, they are going to have to print money, crash their currency, and eventually they may be forced to liquidate their biggest asset to save themselves.
And that asset happens to be over $1 trillion of U.S. debt.
Exactly. If they sell, U.S. rates skyrocket. That is the blast zone.
Okay, let's back up. Let's look at the latest news confirms the election in Japan is finished. It wasn't even close, was it?
No, it was a total wipeout. The ruling coalition, led by the LDP, the Liberal Democratic Party, they secured 350 seats. The Prime Minister's party alone took 316.
Just to put that in perspective for everyone listening, that's a supermajority. The opposition is sitting at what, under 50 seats?
Yeah, under 50. They're irrelevant.
Completely irrelevant. There is no gridlock, there are no checks and balances. Prime Minister Minister Takaichi now has a blank check to do whatever she wants.
And what she wants to do is expensive. Very expensive.
That's the key here. This isn't a government of austerity. This is a government of aggressive expansion. Let's look at the numbers in the 2026 budget proposal.
It is staggering. I mean, the budget is set to explode to over 122 trillion yen.
And in U.S. dollars for us, you're looking at what?
Nearly 800 billion.
Wow. And a huge chunk of that is defense, right?
Defense spending is hitting 2% of GDP. Japan is rearming. They're stimulating the economy, building infrastructure. It's a guns and butter approach on steroids.
But here's the question I always ask when I see these government spending sprees. Japan already has the highest debt in the industrialized world. They don't have a surplus. So where is this money coming from?
That is the trillion-dollar question. They can't pay for it with taxes. The revenue just isn't there. So the only option, the only way to fund this blank check is to issue more debt.
So they have to sell a massive trench of new bonds.
A massive trench.
And this is where we need to get a little technical for a second, because this is the mechanic that changes everything. When a government floods the market with new bonds, what happens?
It's just basic supply and demand. If you flood the market with supply, in this case Japanese government bonds, the price of those bonds goes down.
Right.
And in the bond world, when the price drops, the yield or the interest rate goes up.
Okay. And for the last, 10, 15 years? Japan has been the land of zero interest rates.
Zero, or even negative. Since 2011, money in Japan was basically free. That is over. With this new spending plan, the 10-year yields are already climbing well past 2.2%.
Which, to an American paying 7% on a mortgage sounds like nothing.
Oh.
Why does 2% matter?
Because the entire Japanese economy is built on the assumption that rates will stay at zero forever. When you go from 0 to 2%, you aren't just increasing costs a little bit. You are changing the physics of the financial system. It's a seismic shift.
So the government is spending money it doesn't have, which forces rates up. But looking at the Prime Minister's platform, there's another piece of this that seems almost self-sabotaging. Let's talk about the tax cuts.
The irony of stimulus, it's classic. Takaichi wants to be a populist. She wants to help the average Japanese household with the cost of living.
Right.
So she's proposed cutting the consumption tax on food from 8% down to 0.
Which sounds great. I mean, who doesn't want cheaper groceries?
Politically, it's a winner. But mathematically, oh, it's a disaster. That tax cut slashes government revenue by another 5 trillion yen.
Which is what, about $31 billion?
About $31 billion that just vanishes from the budget.
So let me get this straight. They are increasing spending to historic highs, and at the very same time, cutting their income by $30 billion.
Correct. They are digging the hole at both ends.
So the deficit gets bigger. So they have to issue even more bonds. And since private investors are getting nervous about all this debt, who's left to buy the bonds?
Well, the Bank of Japan, the central bank. They are currently buying nearly 3 trillion yen worth of bonds every single month.
They're printing money.
They are printing money to buy the government's own debt just to keep the lights on.
And we know how this story ends. If you print that much money, what happens to the currency?
The currency collapses, supply of yen goes up, value of yen goes down. We're already seeing the yen trade near 158 to the dollar.
And this brings us right back to the grocery store. The Prime Minister cut taxes to make food cheaper. But does a weak yen make food cheaper?
It does the exact opposite. You have to remember, Japan is an island nation, very few natural resources. They import 60% of their food.
60%.
And they import 90% of their energy.
90%.
90. So think about it. Japan buys oil and wheat on the global market. That market is priced in dollars. So if the yen crashes, it costs way more yen to buy the same barrel of oil or the same bushel of wheat.
It's called imported inflation.
Exactly. The government gives you a tax break at the register, but the price of the milk has doubled because the yen is worthless. The consumer loses, the government loses. The only thing that goes up is inflation.
So they're shifting from decades of deflation where prices never moved to a sticky inflation of 2%, 3%, or maybe even higher.
And once that inflation genie is out of the bottle, you can't put it back in without crushing the entire economy.
This leads us to what our sources are calling the death spiral math. I was reading through the material on their debt servicing costs, and it is genuinely terrifying.
It's the math of a failed state, essentially. Japan's debt-to-GDP ratio is 260%.
Help us visualize that.
Okay, imagine a household that earns, say, $50,000 a year, but they owe the bank $130,000. Now, if the interest rate on that debt is 0, they can kind of survive.
They just make the minimum payments and move on.
Right, but rates aren't 0 anymore. If Japan has to refinance that massive mountain of debt at 3% interest, which is where the market is heading, the interest payments alone could eat up 35% of the total government budget.
35%, just on interest.
Just interest, not paying down the principal, just treading water. That means cutting education, cutting infrastructure, cutting pensions, everything.
Sounds like a trap.
It is a trap, and the markets see it. That's why you're seeing these headlines about the Japanese stock market, the Nikkei hitting record highs, breaking 56,000.
Yeah, I saw that, and my first thought was, well, their economy must be booming.
And that is the inflation illusion. The economy isn't booming. The currency is dying. If you hold cash in a Japanese bank, it's losing value every single day. So people are panic buying assets. They're buying stocks. They're buying gold. Gold is trading over $5,000 an ounce in this scenario.
It's not a bull market. It's a lifeboat drill.
It's exactly that. People are grabbing anything that isn't paper money.
Okay, so Japan is in trouble. That is crystal clear. But this is the deep dive. Our listeners are in New York, London, California. Why does a debt crisis in Tokyo matter to them?
This is the part that keeps me up at night. The transmission mechanism is global, and it comes down to 2 things: the carry trade and the U.S. national debt.
We hear carry trade thrown around on financial news all the time.
Yeah.
But I want to really break it down, explain it like I'm 5 or maybe a smart 12-year-old. How does this machine work?
Okay, imagine you have a rich uncle, let's call him Uncle Japan. For years, Uncle Japan would let you borrow money for free, 0 interest.
I love Uncle Japan.
Everyone did. So Wall Street traders would borrow billions of dollars worth of yen from Uncle Japan for free. Then they'd take that money, convert it to US dollars, and buy safe US assets like Treasury bonds that pay 4 or 5% interest.
So I borrow at 0 and I earn 5. I'm pocketing the difference for doing absolutely nothing.
It was the world's easiest trade, a free money machine. There are trillions of dollars tied up in this.
But now Uncle Japan is in trouble. And he's changing the rules.
Exactly. Japanese rates are rising, borrowing isn't free anymore, and at the same time, because the yen is so volatile, the risk is going up. The gap, the spread between what you pay in Japan and what you earn in the US is shrinking.
So the profit margin disappears.
Worse, it can turn into a loss. And when that happens, all those traders have to unwind the trade.
Walk us through the unwind.
To pay back Uncle Japan, they have to sell the US assets they bought. They sell the US Treasuries to get cash. Then they convert that cash back to yen to pay off the loan.
And when you say sell U.S. Treasuries, we are not talking about pocket change.
No, we are talking about a massive synchronized sell-off. We saw a preview of this in the market shocks of 2024 and 2025. When the carry trade unwinds, it's like someone yelling fire in a crowded theater.
Everyone runs for the exit at once.
And that selling pressure hits the U.S. bond market hard.
It crashes the price of U.S. bonds. And remember, when price goes down,
Yields go up.
yields spike. And this is where it hits your wallet. U.S. Treasury yields are the benchmark for the entire global economy. If the 10-year Treasury yield spikes, mortgage rates in the U.S. spike.
Yes.
So if you're looking to buy a house in Ohio, your monthly payment just went up because traders are unwinding positions in Tokyo.
Directly. Your auto loans go up. Your credit card APRs go up. Business loans become more expensive. It acts as a massive brake on the U.S. economy.
And it's not just loans, right? I'm thinking about the stock market. Specifically, all those high-flying tech stocks.
Big tech is incredibly sensitive to interest rates. Companies like Nvidia, Microsoft, Apple, their valuations rely on future growth. When interest rates rise, the value of that future growth drops.
So a spike in yields caused by Japan could trigger a crash in the NASDAQ.
It absolutely could. We could see a massive correction in the S&P 500, triggered entirely by foreign exchange dynamics.
But wait, there is an even bigger threat here, isn't there? We talked about private traders selling, but what about the Japanese government itself?
This is the nuclear option. Japan is the largest foreign holder of U.S. debt. They hold over $1.2 trillion in U.S. Treasuries.
1.2 trillion. That is a massive stockpile.
Well, it is their war chest. But here's the scenario. The yen is crashing. It blows past 160 to the dollar. It's in free fall. The Japanese government has to intervene to save its currency.
How did they do that?
To prop up the yen, they need to buy yen in the open market. To buy yen, they need dollars to pay for it. So where do they get the dollars?
They sell the treasuries.
They dump that $1.2 trillion stockpile onto the market.
If they start dumping hundreds of billions of dollars of treasuries, the U.S. bond market breaks.
It would be a global margin call. Yields would explode upwards. The U.S. government's own borrowing costs would become unsustainable. It would force the Federal Reserve into a corner.
A terrible corner.
Do they print money to save the bond market and cause massive U.S. inflation? Or do they let the market crash? There are no good options.
It creates a crisis in Washington instantly.
Instantly. It also destroys political plans. Think about the push for reshoring, bringing manufacturing back to America. Think about the energy transition. All of that relies on borrowing money to build factories and infrastructure.
If borrowing costs skyrocket, those factories don't get built.
The math just stops working. A tax cut in Tokyo literally stops a factory from breaking ground in Michigan. That is how interconnected we are.
So let's look at the big picture here. Is this inevitable? Is there an off-ramp? Can Prime Minister Takaichi just not spend the money?
It is very hard to see how she was elected on this specific mandate. The people voted for the spending. The political will is to go big. And geopolitically, Japan is feeling cornered. They're moving away from China, closer to the U.S. and the G7. They feel they need to rearm.
So they are committed to the spending.
Yeah.
Which means they're committed to the debt.
Which means the collision course is set. The sources we analyzed describe this situation as a ticking clock. We are in the calm before the storm. The election was the trigger. The budget is the fuel. Now we are just waiting for the spark.
It's terrifying to think that the stability of the U.S. economy is resting on the decisions of a central bank in Tokyo.
That has been the reality for a long time. We just chose to ignore it because rates were low. Now that rates are rising, we can't ignore it anymore.
So, for the listener trying to make sense of all this, what is the takeaway? If you're managing your own money, what do you watch?
You have to watch the yen. It is no longer just a currency pair for forex traders. It is the canary in the coal mine. If you see the yen start to crash aggressively, you need to be ready for volatility in U.S. stocks and bonds.
And understand that the era of easy money is over. The global liquidity tap is being turned off.
Correct. Cash becomes king and debt becomes dangerous.
We always like to leave our listeners with a final provocative thought, something to chew on after this is over.
Okay, here it is. We know Japan has this massive stockpile of ammunition, that $1.2 trillion in U.S. Treasuries. They hold it to save themselves in a crisis.
Right.
Now, the U.S. government will be furious if they sell it. It hurts the U.S. economy, it complicates our own debt problems.
But if you are the Prime Minister of Japan,
Exactly. Put yourself in her shoes. Your currency is collapsing. Your voters are seeing the price of rice double. Your political survival is on the line. Do you care what the U.S. president thinks? Or do you save your own house from burning down?
it's the ultimate game of chicken. Japan has to choose between their own economy and the U.S. bond market.
And history tells us politicians always choose their own voters first.
The question isn't if they will use that stockpile, but when. And when they do, is your portfolio ready for the U.S. bond market to lose its biggest buyer?
That is the question everyone needs to be asking right now.
Keep your eyes on the charts, everyone. It's going to be a bumpy ride.
Thanks for listening to The Deep Dive.
Stay safe out there.
See you next time.